Inflation hit this morning, and the numbers are looking more positive. Bank stocks, specifically what I wanted to look at was KRE, which is, of course, the ETF for the regional banks. These guys have really been pressured quite a bit simply because they don't have the same tools that the regular financial industry would have regarding being able to combat higher interest rate increases. KRE stock, the ETF, shot up. Is there more in the tank? I want to talk about this, kind of break down some things to show you what I'm looking at and how I plan on making a couple bucks real quick on KRE. Let's jump in. If you're just joining me for the first time, thanks so much. What I try to do is break down the broader stock market, all the different little aspects of it, to give you a bigger picture as to what's going on with not just, say, SPX, the index for the S&P 500, but all the different facets of that and what affects that. I'm an economist first and foremost, and that's what drives all my decisions. I did take a couple days off. Unfortunately, regrettably, I had a medical emergency. I'm just getting back after almost a week of taking off. So I just launched this channel. If this is your first time, please, by all means, hit that like and follow button. The channel's growing quite rapidly. Thank you so much for all that. For those of you who have been following along. Here we are looking at U.S. core inflation rate. And as you can see, we saw a pretty decent little slide downward since about a year and a half ago. But this is the position I've been maintaining for some time, that getting to that magical 2% is not going to be nearly as easy as everybody thinks. And although the downward move was welcome, I think we're a long way away from actually getting to 2%. I do believe the Federal Reserve is going to have to raise interest rates higher at some point. And it's not just inflation. This is sort of one of the things that you have to look at, of course, but the other aspects of what's really driving the Federal Reserve's moves in keeping inflation or interest rates higher for longer is M2 money supply, the Federal Reserve balance sheet, banks' balance sheets, things like this. They all kind of work together. The M2 money supply, the amount of money out there in liquidity, too much, too fast. And in order to bring that down, you have to raise interest rates for a long time and keep them up there. So we're up to 525, 550, somewhere in there. For the short-term interest rate, the 10-year, the longer end of the curve is adjusting to that. I think it adjusted downward too much, that there's still a long time that this is going to be there. So although the U.S. core inflation rate is a positive development, there's too much of a deficit right now. This will continue to pressure the 10-year, and we'll probably see that pressured higher, although last week we saw some good buyers step in on an auction they had. So that was good news. But ultimately, I don't think this is, say, the last nail in the coffin for the Federal Reserve raising interest rates. I don't think they're going to get to 2% inflation quick enough. I think they're going to have to be like, you know what? It's just not getting there fast enough. We did a pretty good job. We're going to raise it. Maybe they have to raise it another 25, 50, 75 basis points over the course of, say, 2024 in order to finally get inflation down below that 2% level. So when you're talking about bank stocks in general, and let's take a look at what this is. KRE. It's the S&P 500 regional, Spider S&P 500 regional banking stocks. Bank stocks are smaller than the behemoths, the Citis, the JP Morgans. They don't have the tools to hedge against higher interest rates as much as, say, JP Morgan. We're going to see a lot of foreclosures on office buildings, on car loans, on bank loans. We're starting to see these things grow in size. Credit card delinquencies in general are really starting to rack up. These smaller banks don't have the ability to put aside reserves as well as the bigger players. And because of that, KRE stock Here's a weekly chart on this. Really took it pretty hard, especially the beginning of the year in March, I think was when we lost the bank out in Silicon Valley Bank, SVB. These banks are not all of a sudden going to become profitable. So I'm looking at this and I'm saying, okay, fine, there's a good rally, but let's be real. There's limitations to what's going to happen here. We're going to see another news event or media, someone's going to say something saying to the effect, which we just got last week, the Federal Reserve Chairman say, yeah, if I have to, I will raise interest rates again. And this will probably keep a lid on KRE for right now. But the long-term outlook, when you're looking at these banks and their balance sheets and what's about to hit with an economy that is already starting to cinch up a little bit, we're starting to get numbers out of the major retailers. They're starting to contract. They're showing signs that the consumer is choking. Those consumers are starting to default at a higher rate with credit card debt and home loan debt that is at record high. These regional banks can't weather that storm too much. So when I see moves upward like this, a relief on something that really isn't necessarily a huge turning point for the banking sector itself, I look at this as an opportunity. I stepped in after today and I said, you know what, that's an easy one. I sold some calls just 2 weeks out, about next Friday. Those calls, I expect they're out of the money. I'll expect those calls to expire worthless. I'm basically bringing in premium. I'm not necessarily picking a direction. I'm just saying, okay, fine. Volatility, Vega went up, and I'll sell into that Vega. Now I'm just going to play theta, time. And as time keeps playing down, I'll just keep bringing in money. But I don't ever expect that stock level, which I sold 48s, the 48s, I don't expect them to hit in the next 2 weeks. I don't expect everybody to be jumping in and buying these stocks on a regular basis simply because of what happened this morning. Ultimately, the market forces are still in play. Interest rates will remain higher for longer, and these bank stocks are not exactly going to be profitable anytime soon, more so in these conditions. Instead, just the opposite. So there was a relief rally today. I'll sell into it all day long. Here is a look at XLF. XLF is the ETF. XLF stock is the ETF on the financial sector. And they fairly mirror each other, but this will have the bigger players in there. This will have, some of those stocks in there that aren't necessarily banks. They're financial sector players. So their outcome is going to be a little different. I'm not exactly sure that we'll see, say, 36 anytime soon with XLF. There are some stocks that are going to do well in the XLF sector, but I don't think overall all of them are. For me, I'm maintaining exactly the same heartbeat over and over and over again. Interest rates will remain higher for longer. If the Federal Reserve does have to lower interest rates anytime soon, it's not a good thing. It's because they went too far. This economy looks like it will start contracting rapidly. And it's because the consumer is having to rein things back in. That's not in an environment where all of a sudden businesses are bringing in more revenue and profits. So these stocks, I expect, will start to sell off even further. So although today we did get some fairly decent news with regard to inflation moving in the right direction, it is just a breadcrumb. And that's all it is to me. I'm still playing the same thesis, and I will for some time. Make sure to hit that like and follow button, and I hope to be feeling much better and I can go ahead and get all this content out there on a more regular basis. Thanks so much. See you in the next video.